Where I live on Wednesdays, it's garbage day, and we're going to talk about that today on Open Interest. Hello, everybody, and welcome. I'm Mike Coe. Welcome to Open Mic. So, most of you will probably know that I live in Northern California. Northern California is a place where they care a lot about recycling. Wednesday morning is garbage day, and we have something called dual stream recycling here. Dual stream recycling means that we actually have a grand total of 4 bins. One is for the regular solid waste. One is for what they call containers. That's, glass bottles and cans. One is for compost, mostly just grass clippings. And the final one is for paper. And it was while I was dealing with the paper bin, which is one of the 2 largest of the 4 bins that we have, it just, annoyed me once again that we never have quite enough space in that bin for the amount of cardboard that we now seem to generate. A product almost certainly of the fact that more and more of the things that we consume are shipped to us. And if it's shipped, it comes in a box. And if it comes in a box, you're going to end up with a lot of cardboard. And as I was thinking about that and came back to the desk, I was reminded of the screen that I shared with all of you on Monday as I was talking about selling strangles. So if we can pull the screen up again, what you're going to see is a name that happens to be on the list of stocks that I was screening. I'm going to blow this up a bit. Actually, I don't need to blow it up that way. I can blow it up this way. So I'll just make this a little bit bigger and drag this over here. What is the company that I am talking about? It is this one here. Packaging Corp of America. Packaging Corporation of America. Packaging Corporation of America makes cardboard boxes. Quite a lot of them. And so it's interesting because this company, or its earliest origins, I think date back to before the Civil War. The company is based in Lake Forest, Illinois. I believe that its earliest predecessor was founded in the 1860s. And we can confirm this if we go to their website, I'm sure. Packaging Corporation of America. Let's just pull this over here. Get a look. And I'm pretty sure I saw right in here history. Our PCA's history. Here we are. 1867. Henry Weiss founds the North Star Mill in Quincy, Illinois. 1903, the Ohio Boxboard Company is founded. And so on and so forth. Packaging Corporation of America itself is formed in 1959. And I think the company went public back in 2000 or thereabouts, if I remember. Let's see, am I right about that? Yep. There we are. So there it is. 2000, it becomes publicly traded under the ticker symbol PKG. So other than the fact that I'm annoyed by the amount of cardboard that I have sitting out on the street on Wednesday mornings, and is the fact that you take one of the oldest companies around and one of the newest economic developments, and what you find is a situation like this, a very steady grower. In fact, as you can see here, the forecast now is that their growth is poised to accelerate next year versus this year. What does this translate to? 18% year-on-year adjusted net income growth, or adjusted EPS growth, I should say. More accurately, the net income and the adjusted EPS growth may not necessarily be the same, depending on buybacks, which I didn't even bother to check. We will take a look. Because when I think of this company and returning capital to shareholders, what they principally do is pay a dividend. They increased the dividend to $6 a year. It was previously $5, so they were paying $1.25 each quarter. Now it's $1.50, so a 20% increase in the dividend year on year. This isn't necessarily the same thing as some other big dividend growers, which basically you see a kind of a consistent uptick in the amount of the dividend that they provide each year. But that is a meaningful change. Let's actually take a look and see if they did any buybacks as well. So they have a $1 billion buyback in place, 77.5% completed, about just under $250 million, or about 1 million shares at the current price remaining. So they're returning cash to shareholders in this way as well. So just an example of a business that, even though it's an old industry and one of the oldest companies in the world, if you go all the way back to the business in 1867, that does not mean that an old business can't benefit from new changes in the economy. The likes of Amazon and FedEx and UPS and Alibaba, all of this stuff was not anticipated by Weiss when this company was founded almost 1.5 centuries ago. And yet they're beneficiaries today. Valuation seems to me to be fairly reasonable looking at 2027 earnings. We got the adjusted EPS number down here, $12.30 a share. So that puts the company at, and this is almost no change in it at all since yesterday. It was just under 225 yesterday as well. 18.24 times earnings. I'm going to round, call it $790 in anticipated free cash flow over a 23.750. What the heck? We'll call it 23.75 billion. 3.33% free cash flow yield. So yeah, I thought this was kind of an interesting. I thought it was good from a dividend play in terms of valuation. As we are trying to figure out, are we in a bubble? Are we not in a bubble? What's going on? Some of these stocks are behaving quite unbelievably. I look at the old poster children for the tech bubble that I lived through in the late 90s and 2000. Companies like Intel. And, take a look at what Intel has done recently. So this is the last year. And let's take a look at, well, that's not quite the last year. Let's make it exactly the last year. So we'll go 06/03/2025. There we go. So that's a year's worth of stock performance in Intel. Now, if I go and say, okay, well, what did it look like from, I don't know, March 10th of 1999 to March 10th of, and I didn't look at this before today, so you're going to see this same as me. What did it look like then? I mean, the move's been more aggressive now than it was then. Let's take a look at Cisco. Poster children that they were in 2000. And we'll just advance the clock and we'll say, okay, what does it look like today? Even steeper. So as you look at that and you say to yourself, okay, can this kind of thing persist? Looking at companies like Package Corp of America seem interesting. Now, one other thing I just want you to think about as we look at this, so we're going to go back to Package Corporation of America and the present day. And I look at this and I think, okay, well, this thing is probably going to bump into a little bit of resistance when it gets into this area here. So what if I look out to July, 6 weeks, and I said, well, what if I sold a call up here? I mean, could it get there? It could. Is it likely to? No, maybe not. We like the business. We think it's steady as she goes. Decent free cash flow yield. Respectable dividend. But if I can get something for that 250 call, maybe I can actually enhance my yield a little bit more. And I'll just go out to July and we'll see what we've got on that 250 strike. And that 250 strike is 210.265. I think a reasonable target price, and not even a fairly aggressive one. Mid-market is going to get you up around 235, 237.5 in that neighborhood. But even 2.25 would be reasonable. 2.25 is the current stock price, give or take 1% of the current stock price. So then you're going to collect your dividend, and you're going to get an extra 1% every 6 weeks or so, and still have decent upside. So 252 and a quarter, we'll call it, over 224.30, 40. That's 12.4% max gain between now and July expiration. To me, for anybody who's thinking about putting new capital to work, who's getting a little bit anxious about what we're seeing in the markets right now, this is an interesting way to play it. It was one of the other things that was interesting is I immediately looked to see, because I was curious. I actually assumed this was going to be in our Quad D fund. So this is our double distribution, kind of like a dividend aristocrats fund. It's based on the Dow Jones US 100 dividend index. I was almost dumbfounded that this one didn't show up in here, because it seems like the perfect, it seems like the perfect constituent for a portfolio like this one. We don't happen to hold it in Quad D, but this is kind of the thinking behind Quad D. Quad D companies tend to be more mature. They're paying dividends, and we do some light overwriting to enhance the distributions that you would get from the dividends. So that was kind of something that I thought would be interesting for us to take a look at, inspired by the big pile of cardboard that has since been removed from my street. Okay. So let's see. Penn and Teller prove that this approach doesn't make sense by asking people to collect in 12 bins. Yeah, that doesn't surprise me very much. There was a great, I have to say, so the refuse company that picks up our recycling, picks up our garbage, does so for a number of towns in this area, including a neighboring town of Tiburon, California. And I happened to be in downtown Tiburon. I was taking some pictures, and as I was taking some pictures, the refuse company came by to start emptying the garbage cans, the public garbage cans that were right there by the waterfront. There's a ferry terminal there, some restaurants and whatnot. And I'm watching them empty these garbage cans, and I watch them grab the solid waste can, brings it over to the truck, empties it, and then he grabs the next two recycling bins. And they just went right into the same thing. There was not separate compartments in this truck, mind you. He literally took one out, dropped it in, rolled it back in. And then I actually think I saw a post. Somebody put it on Nextdoor or something and said, they happened to make the same observation that I did, that it seemed awfully strange that they're making us separate all this garbage into separate containers, and then they just drop it all into the same truck, in the same hopper. I don't know. Something about this that doesn't seem quite right. But it almost seems like they're doing this just to see what they can get you to put up with. You know what I mean? Hop on one foot. Hop on the other foot. I don't know. And meanwhile, in Japan, they have waste handling facilities where everything just goes onto one conveyor belt, and their technology sorts it all out, which seems to me like a better approach, not only in terms of convenience. You don't have to have multiple trucks that are probably all carrying the same stuff, but some people are going to make mistakes. If everybody has kids the way I do, sometimes you look in the recycling bin and you say, "What are you doing?" This is paper. That's a can. I mean, you're 16 years old. Figure it out. But sometimes they don't care. Okay. So, Packaging Corporation of America, beneficiary of the fact that everything is getting delivered to your door and probably in a cardboard box. And if you go to Costco, there's a lot of boxes that are, getting loaded into cars there too. So the box business is a good business. And a buy right. The box business is a simple business, and a buy right is about as basic as it gets in terms of option strategies. You buy the stock, you sell calls. If you get called out, you can sell puts on the thing. the puts will have a bid because the thing pays a dividend. Write your way back in and basically just continue to play that game again and again. Okay. Justin Matthews, my Bitcoin and strategy plays looking rough. Best options for this kind of volatility. It is interesting, Justin, that you bring up Bitcoin and strategy. I was just taking a look at these things earlier today. And of course, the reason for this is because of strategy's rather interesting and curious announcement that they had their first sale effectively of Bitcoin. And then Michael Saylor said, back to business as usual, which suggests he's just going straight back to buying it. They didn't sell a whole lot. I think they sold 32 Bitcoin is what I just heard from Ambassador of Quan when I was on a call with him earlier today. And I found that very curious also. So they did retire some debt. I have not had the time since that call to dig into this a little bit more deeply. We touched on this during office hours yesterday. It has a little bit to do with corporate accounting, and this is what I want to investigate. And that is that companies mark their assets to market. Some will also be marking their liabilities to market, which in most cases could represent some of their publicly traded debt. And if you buy some of that back in the open market, you might be able to retire it at a reasonable valuation. So, and perhaps less than the actual liability is. So, I'm wondering whether that was part of the case, but it is an interesting situation. Bitcoin seemed to be catching a bid. Let's take a look at that first. It seemed to be catching a bid this year, starting in about February. So let's go back to the beginning of the year. We'll go back to December first. So that. So right here in February, it seemed like it was coming back to life, as you can see. And then it has very rapidly given almost all of those gains back since then. My view is this used to be a relatively simple thing to do, which is just sell some premium against it, because the volatility of Bitcoin and of many things that were tied to the trade was very, very high. And that's not what I wanted to do. I'm going to use IBIT. So as we look at the volatility, one of the things that has happened, let's go back a little bit more in time here, is that it has even, normally when the price drops, you often see volatility increase. But one of the things that has happened here is, I'm going to just, we'll look at one of these and then the other, is that in general, you can see with some intervening spikes, that in general volatility is lower now than it was 2 years ago. And these are now options premiums. And I think you can see there's obviously some spikes that took place in here. But in general, the trend here is lower. In fact, if you had said to me 2 years ago that Bitcoin would be trading at 30 vol, or even that it might be trading at less than 30 vol, that would have seemed pretty ambitious. But what the byproduct of that is that means that the amount of premium you collect in this is not quite as compelling as it was. Still, though, I think that it probably does make sense to, if you're going to continue to want to hold a position like this. Let me do this. Let's just take a look here. So we'll look at YBIT. So what does YBIT do? It's just basically long IBIT, or a proxy for it. And I'm just going to compare that to IBIT, since that's a different kind of a thing you could have. And just see what the total returns look like. It's a little bit better, as you can see. And if we just take a look since Bitcoin really took it on the chin. You know, it's modestly better because you're reducing your exposure a little bit. So, I mean, this is not quite a year, so 5% over a year. I mean, when the underlying asset's doing this, it's not a huge boost, but it is a boost. So one thing you certainly can think about doing is continuing to just overwrite. And in our case, what is going on here is it is overwriting with call spreads rather than just naked short calls. And the logic in that case, and you can see this is really modest call spreads we're talking about. So just look over here. You can see short the 40s and long the 41s. So you can tell that these two pair off because that's long 8,100 calls and that's short 8,100 calls. And then you can see there's another 4,900 lot of short 39.5, 40.5 call spreads. So that's pretty tight strikes. Do you need to go that tight? That means your premium's going to come in a little bit. Well, you can do that if you like. Let me show you what kind of a boost that gives you. If I can, let's do this. Bring over the charting application here. And let's look at strategy stock. Why not? So depending on how complicated you want to get, and perhaps you don't want to get that complicated, maybe call spreads are a little bit too complicated, maybe trading weekly call options to collect extra premium just takes a bit too much time because you got a lot of stuff to do other than just trade options, I'm sure. You could do something like just go out and trade, regular way options as a mechanism to do it instead. I would probably, if you're really trying to make sure that you're doing it in a manageable way, maybe go out 6 weeks, look to cover this with 2 to 3 remaining, and just chisel away at it, basically. So we can take a look right here. It's 126.5. You can sell something like the July 1 doubles against it. So you got about $30 worth of upside, not including the more than $5.50 in premium that you're collecting. And just roll covered calls. Just take your basis down consistently over time. Still have a decent amount of upside here. That would be a way you could play it. And the other thing is when you're looking at these charts, one thing to think about, try to put that into perspective. So if I'm going out to July, look at the price action over the course of, the last 6 months or something. So you're going to go out 6 weeks, look back 6 months so that you get some sense of what those ranges really mean. So if I'm selling the 1 doubles at over 5, that means that, the risk is that I get called out over here at around 160 and change, right? And even if that does happen, you still want to maintain some exposure, go ahead and sell those puts, the 160 puts, right? And go like that. Just sort of wheel the strategy. Just bring your basis down as much as you can. I think that would be the way that I would play it. I think a funny comment, I think I referenced this yesterday. I wanted to show it, and I forgot to make sure we were enabled to do this because I want to be able to share videos and let you guys hear it. But you can go and look for this yourself. It was Monday. Squawk Box, Joe Kernan, Andrew Ross Sorkin, and Fundstrat founder Tom Lee. And Andrew Ross Sorkin asking Tom about crypto, about Bitcoin specifically, referenced the fact that Mark Cuban said that he had sold his position and that it wasn't behaving like digital gold anymore, and basically saying that it wasn't all that it was cracked up to be. And Tom Lee, and maybe other people have said this, but he said that a lot of investors in it are rage quitting, and I thought that was kind of funny. And he also said that that kind of behavior, that kind of price action, characterized the tail end of crypto winters, which, by the way, is the we do have a fund that takes the other side of strategy called Winter, and that's done. Actually, I have to do total returns. This is not just the price action that matters. We need total returns. I don't want studies. So let me do this. Oop, no, like this. That didn't work. Okay, because of course this is paid dividends along the way. Because that's basically what this is doing. Invalid selection. Nice. Winter. Equity. TRA. Yeah. So this is how this one has done. Basically just overwriting with a a bearish tilt. So it's up 65% or so total returns if you had reinvested in the last 12 months. But I don't really know that most people are going to reinvest. I think that if you're looking to lean against it, taking long-term short bets is a kind of a difficult exercise. So one of the things I like about option income strategies that take short bets is that you get to just peel some of your risk capital out with every single distribution. So just something to think about. But yeah, that's something I would consider for both. Alex V. Strategy broke 147, 127. Next stop could be 117. That's an interesting. Let's look at this. Why don't we take a look at the Fibonacci levels here. And I'm going to look at these because that's what I typically do. What is that level? Does look like it's a I don't know. I'm not 100% sure what the next stop would be. According to the 1-year Fibonacci would be down here at 104. And if I look at a longer term chart, boy, I don't know. This is, these levels right here, these lows. And if you can hear our dog Sophie making a fuss in the background, she's our next door neighbor has some rodent or something that is living underneath their deck, and I haven't seen it, but it drives her crazy, and she is barking through the fence at the neighbor's rodent problem. Hopefully you guys aren't hearing that as well as I am. Yeah, I don't know. I mean, I would have to say that the next stop, to my eye, is going to be 114, I guess. That's where it was here, right? Is that what that was? I mean, the moves are so dramatic, you actually have to really zoom in to get a look, but let's see what the other technicals have to say. Let's call on Bloomberg's capabilities of ranking technical indicators to see if any have taken a... Oh my goodness. You don't see this too often. That is really quite extraordinary, actually. So, just as a reminder to everybody, these arrows, if the arrow is pointed higher, that means that that technical indicator would be net long. And if it's pointed lower, then it would be net short. If it is green, that means the trade is profitable. And if it is red, that means that it is not profitable. And I think what we can see is that all of these, currently hold a bearish indicator, as do all of these. Now, I don't need to tell any of you that, of course, it's all the bearish ones that are profitable because we just looked at the chart. Thing is lower. But I don't know the last time I've ever seen something where one side of the boat was so heavily loaded. I don't know. I mean, actually, that in a way, I just the natural contrarian in me makes me think, well, if everybody's looking down, and almost everybody is, commodity channel index is an exception, as the Williams over here. I don't know. Maybe we're getting close to a speculative long. My 2 cents. Just because the snapback, a bear market rally can be quite vicious too. So even if the longer term picture is impaired, it does feel like it's setting up well for. What's the short interest in this thing right now? 12% of the float. Look at the S3 squeeze score here. Substantial risk of a short squeeze. The S&P Global Short Score is based on the percentage of shares outstanding. I'm just reading it to you in case you can't make it out. The S&P Global Short Score is based on the percentage of shares outstanding in the security that are put out on loan. A score of greater than 3 is considered high. So, I don't know. I think there might be, we could get a violent up move in here. There's a lot of people who have it in for a strategy stock. I don't ever, I don't have anything personal about it one way or the other. I do tend to believe in Bitcoin because I don't believe in the dollar. So I look at this and to me it seems like it's setting up for a violent up move in here somewhere. And if we get that, because it has, sometimes these things can have a little bit more of a commodity trading characteristic, we might get a vol spike as well. That could also be a nice time to start selling some options premium. Okay. Alex, I have 127, 117 put spreads. Yeah, I mean, I get it. I mean, everything seems to be leaning against it. Steve is saying 117, maybe 104. I think the 117, I don't see a whole lot at 117. 104 looks more definitively like there would be support there just based on where the stock was. Yeah, so, okay. Prospects for GLD or for gold. Let's do the same exercise for gold, shall we? So let's see what this looks like. We do have some exposure to the space because we have sort of a non-correlated sleeve in one of the discretionary funds. Plus we have GDXY and we have Miney, which is both precious and industrial metals. But yeah, I mean, this has also been under some pressure. I don't think it has quite the snapback potential at the moment. Because it doesn't seem quite as crowded on the short side. But this is the problem here for me, which is, as you guys will know, I'm not enamored of picking things up when they are below their long-term moving average. The one I use, or that I'm supposed to use, is the 150, the 200 also. So when I do screens, like the thing that's showing up on the Packaging Corp of America, that happens to be using a 200-day moving average as a screen for that security selection process. And the reason is because it's a setting. So in one of the screening applications that I'm using, it's just a box for me to tick. So I can just say I want to compare it relative to the 200, and comparing it to the 150 in that application is more challenging. And it's something I just run every day, so it's easier for me to just use whatever the defaults are. And it's, generally speaking, in most cases, it's pretty close. I'll put the 200 in here, and you can get a sense. Well, that would be the big difference. But they're generally pretty close to one another. Carter is the one that sort of got me started on the 150, and I've kind of, it's been my inclination, and he says that they've, done some work, done some research, and found that it worked a little bit better. Maybe it does, maybe it doesn't. But if there is any case to be made, it is actually in this area, because I would say that if it goes below this, level right here, you're finding yourself in some pretty significant trouble. Because for those that look at this, you're now, what is that level, by the way? That is 407 is where we are right now. I can't quite make out what that is. 403.70, right? So hovering right on the danger zone. Another move like today, and you're going to violate that level. And that could present some technical problems. But, maybe not. Maybe it holds there, and you can lean on that. But we've been observing a nice and prolonged uptrend for a long time, but and here's the other thing. So let's just do this real quick. If we drew some other lines, we could draw some lines that might look a little bit, like this. Draw another one over here. That should probably be down a little bit lower. Yeah, I don't know. It looks like it's a pretty ticklish spot. This looked like it was forming a bit of a wedge, and but it looks like maybe it did that already. Let's take a look at the 150. Yeah, see, this is the interesting thing. So this is one of the things that Carter will do very often, is that he's looking at the 150, and then he looks for periods when you start to see prices come in and consolidate a little bit, and then looks for a resolution. And I think I'm not going to speak for him. He's the one who would be better positioned to talk about this than I. But that looks pretty difficult. Actually, you know what? Let me see if I have any recently published research from him. See what he had to say about it. Let's see. Nope, unfortunately not. I thought maybe he would have recently sent. I would be looking for something that came in, just in this region right here. I'd be curious to get his read, and I will do that. Unfortunately, I won't be able to do it in time to give you an update, but maybe I can update it on Monday. So I will speak to him before then, I am sure. Okay. Tuckerty Dog. We used to sort, and 2 trucks came on different days for 2 types of bins. Now just 1 truck, and it all goes in. I'm telling you, what is the likelihood that the same waste collection company is, dumping multiple bins into a single truck in the same hopper in one location 2 miles from here, and that over here the identical trucks going by aren't doing that? It's possible. And what are they doing with that 1 truck? Is that like a whole separate thing? They just decide that they're not going to recycle that load? Or I have no idea. The whole thing seems very fishy. That's what I think. Steve Garcia. I live in Marin, and I have the same trash bin situation. The paper bin is never big enough to dispose of all the Costco and Amazon boxes we get. You live in Marin, you go to the Costco in Novato, don't you, Steve? I go to the same one. So, Alex V. In SoCal, 3 bins, 3 trucks, but people frequently mix up all into 1 trash bin. So I've also lived in Southern California. That's where I met my wife, actually. Where in Southern California are you, Alex? I'm curious. When I first met my wife, we lived in Santa Monica, and a little bit later, when we had kids, we bopped around a little bit, but we were in Palos Verdes for a little while, which was great, except for two things. For people who don't know Southern California, Palos Verdes Peninsula is the southernmost part of Los Angeles, basically, before you start getting into Orange County, Long Beach, stuff like that below you. And it's a great area. It's a beautiful area. The only problem, there's two big problems with it. One of the problems is that, California's freeways pretty much everywhere you look. But in Palos Verdes, you're actually pretty far from the freeway, so it's not that easy. And the freeway that you're closest to is the 405, which is just a complete disaster, trying to get north and south on the 405. That was a problem. And the other problem actually was that there are two big refineries that operated in that area in San Pedro, and Torrance, California, which is just inland. There's a big shipping terminal, so you can often, if you ever are visiting the Los Angeles area, you're on the beaches. If you're in Manhattan Beach and you look out, so Manhattan Beach is just south of LAX. If you look out, you're going to see tankers out there. And so a lot of people don't know this. California was a big oil-producing region. It's actually the fourth largest, I believe, oil reserves of the 50 states, after Alaska, Oklahoma, and Texas. I'm going by memory, so forgive me if I have that wrong, but I'm pretty sure I'm right. A former oil trader, just going by memory, even if it is 20 some odd years later. And there are two big refineries there. And those refineries, when the wind was blowing the wrong way, my wife did not like the fumes that would come in our direction. Understandably, nobody wants to have the fumes from a refinery. We actually have a big refinery not too terribly far from us on the other side of the bay here in Richmond that I believe is also closing, and Chevron is moving their operations out of state. Not going to help our gasoline problems here one bit to have these refineries closing, because we have a unique formulation for gasoline here by regulation. So, all right, so 3 bins, 3 trucks, but people frequently mix it into one trash bin. SFL trades, package, Oct, 250, 270 credit call spread looks nice with only 12 deltas for $4. Yes, that's a fine way to play it. I'll admit I prefer slightly shorter dated. There's not going to be a lot of immediate theta going out as far as October, so that's kind of why I like July. Here's the thing: when you're selling premium against a long stock position, package, whatever, you're contending with trying to find a balance between an attractive yield, which you can annualize, suitable premium, which is actually a buffer on an instantaneous basis. So, for example, if you sell 0 DTE options, you have the highest rate of decay as a percentage of the option's value, because it's going to be 100%, right? An option that expires at the end of the day is going to lose all of its extrinsic value throughout the course of the day. Can't have better theta than all of it, right? The problem is that the total amount of premium that you're collecting is small relative to the spot, to the underlying price. And so it annualizes well if you extrapolate and just assume that you can collect that again and again. But it significantly mutes the benefit that comes from any amount of hedging. Because if I sell a 101 strike call option on a $100 stock that expires at the end of the day, and I get just a fraction of a percent for it, if the stock falls 10% tomorrow, that's not much of a hedge. On the other hand, if I sell a 105 strike call and I collect 2.5% for it, that goes out 6 weeks, if it falls 10% tomorrow, that call's probably going to go worthless, and so now I've saved 2.5% of the 10, so I've muted that downside move by about 25%. That's a little bit more meaningful. So this is the trade-off that we're always trying to make. Where do we find that sweet spot? Where's that balance going to be found? Another really good example, if you had bought strategy at the beginning of 2025 and sold a 1-year option, 20% out of the money, you'd have gotten about 20% of the stock price for that. So you could have muted completely 20% of the downside scenario, and you probably could have covered that well before the year was out and taken in most of the money. So that's the balance. So the nice thing about the credit call spreads is that you aren't going to completely cap your gains. Let's say the thing got taken. Let's just say that Berkshire Hathaway. So Berkshire Hathaway bought Taylor Morrison last weekend. Maybe they buy Packaging Corp of America this weekend. Old world company, reasonable valuation, has the free cash flow, kind of thing that they like. So they say, okay, we're going to buy Packaging Corporation of America. Well, if they do, maybe they pick it up at a 20. What was the premium to Taylor Morrison? It was like 22%. Just call it 20 to just keep the math easy. So that's, $45 a share over where it traded now. So it's 225 plus 45 gets me to 270, right? So if I sell the 250s or two doubles for 2.25, that's a little different than if I sold the 250, 260 call spread. And maybe that's a better bet. So that's the thing that you're always trying to balance. October is not going to hurt you as much in a rally, and there's a cap on how much it can be worth. That's the good news. The bad news is the theta is a little bit less. So my balance, my preferred balance, is typically going to be inside of 90 days to be sure, and so October falls just outside of that. But I mean, but to your point, the delta impact isn't going to be huge. SFL, let's see here. Eileen says, you guys are smart, Marin. We have one bin for recycling, and no matter how much we wipe off plastics, there is always liquid in the recycling bin. Isn't that annoying? That drives me crazy, too. Yeah, and you try to rinse it out, because sometimes the liquids that go in there are not so pleasant either, right? Somebody sticks a yogurt container in there. My kids like to have yogurt and protein powder. And, I don't dislike yogurt per se, but I don't like the way it smells. And I certainly don't like the way it smells when some of it's been sitting in a bin for a couple of days. I think the Japanese have got it figured out. The Japanese say not one recycling bin and one solid waste bin and this. They put everything into the trash. There's one trash can, everything goes in it, and they have a facility that sorts it all out. Everything gets dumped, and they have things that have magnets that take the ferrous metals out, and you've got shaking things that help take the heavy stuff out. I would like to see that kind of a solution. Then you don't have to worry about cheating. It just none of that. I sometimes think we overcomplicate things. So Andrew, Justin, I think this is the beginning of the end for strategy, I would just sell calls to offset the likely case it keeps going down, and if it pops, you can offload the shares at a reasonable price. Yeah, so that's another thing, right? So if you're going to start doing some overwriting, the downside is that you sell it at a higher price, and in the meantime, you're going to get paid, so you're lowering your basis all along. That's kind of the way to play it. The only thing I would say is that, like I said, just the thing to be careful of, and maybe this justifies the call spreads that we were just talking about, so maybe more credit call spreads in this case, is that if we do get some kind of a crazy squeeze in strategy, simply by virtue of the fact that, it's not completely in squeeze territory, and I don't want to just turn this into, another meme stock, another AMC, GameStop, or whatever. I'm not trying to be roaring kitty over here and say, everybody, get your diamond hands on and just wait. This thing's it's gonna, rip. But it does have a couple hallmarks. The one side of the boat is definitely getting loaded. Short interest is pretty high, and those things combine for, even in a bear market, some big rallies, and I think there's room for that in here. And I think if that happens, you're probably going to get a bid in vol. And as Andrew follows up, at least you'd have a structured approach to reducing exposure. Yeah, that's right. And, how do you peel it off? I think that makes some sense. Finn West, good morning, Mike. I need some help to boost Lulu stock into earnings. I hope you and Holly are adding some Lulu wear and haven't given up on the brand. So I think I've mentioned this a couple of times. Holly, and she's a way better barometer of, and my kids too, of what's popular and what's not. I mean, look what I'm wearing. I don't, this faded black Izod shirt, I have no idea how long I've had this thing. It's not as free-flowing as it once was, so that suggests I've had this thing for a long time, but I don't remember buying it, which means I must have had this thing for ages, right? I don't shop for clothes very often, so they are a better measure of what's popular and what's not. And it's been a while now, and I've said this before, it's not as easily tradable because it's a private company. But at some point, she and the kids, they decided Viore, well, the boys were never really that into Lulu, to be honest. She would buy them things from there, but they never really cared that much about it. But at some point, Viore became the thing. It seems like a couple Christmases ago, suddenly I was like, Viore, what's Viore? And there's a Viore store right near the Lulu place, close to where we are, and that's her preferred thing. So I used to always go to Lulu and just get a Lulu gift card as like a stocking stuffer or whatever. I always knew that would be a hit, and I stopped doing that. I actually went into the Viore store and I found somebody who was working there and I said, "You're about my wife's height and size. What are a couple items that you would like out of this store if you were going to pick?" And then she picked this, that, and the other. And I said, okay, try it on. Looks like it would probably fit her. And that was that. I'll tell you that I look at the Viore stuff. I don't really see it. I got these athletic pants or something that somebody gave me from there. I thought they feel like pajamas. No offense to people who really like the brand. I don't know. But it seems like that's more popular now, for what it's worth. But let's actually take a look at Lulu, because this thing, I did think that it was starting to get pretty cheap. Oh! Yeah, so anybody who didn't watch Office Hours yesterday, yeah, $13. I mean, it is cheap. I mean, let's see here. Technically, it doesn't look too hot, but this thing is cheap. So I can't put it on my Holly Index because she's not really shopping there. We do pick things up there periodically because if you have an American Express card, you get a $75 credit at once a quarter, I think. And I probably forgot it last quarter. I should make a stop over there. I'll buy something, okay? But I don't think I can promise to buy something before earnings. Actually, I could end this live stream and head over to Lulu. If I told my wife, hey, we'll go to Lulu and pick something up, she probably will. She was in Palo Alto earlier today. She went down there early this morning. She's back now. So yeah, maybe I'll go to Lulu and pick up something. Let's see here. And, yeah, so we've got a couple. Look at this. All right, so here we are. We just looked at what an abysmal set of technical indicators look like. But here, actually, this one's bullish. I'll mark the over here. I'm going to just put the bullish ones. Yeah, 1, 2, 3. 4 of the top 5 indicators are bullish. And these have all performed fairly well because remember, so just so everybody knows what you're looking at when you read this, what this is showing you is a hypothetical 1-year look back on a $100 million investment using this indicator to buy and sell. This is what the P&L would be. So the rate of change is a technical indicator over the last year, and it's bullish now. It's not up on this trade, but it has, so far this year, been a pretty good indicator. In fact, all of these, basically from here on up, all of those have outperformed the market. All right, so that's this group here. So of those that outperformed the broad market generally, using a technical indicator on this stock to buy and sell, and we can look at a couple examples, all but 3 are actually bullish. I don't think American Express will let me use the $75 credit towards the purchase of the stock, though. Let's see how this one did. So this one is a very active strategy, as you can see. It's had 124 trades over the course of the last year. So maybe that one's a little bit too frenetic, shall we say. But the moving average oscillator has traded it like this. So it bought it here, sold there for a profit. Went short, bought here, went here. And so basically, the way it's doing it is when there's a buy indicator, it buys, goes long, covers and goes short, covers the short, goes long, covers the long and goes short. Yeah, I mean, so it's the long-term indicator's not great. Looking at the overall technical indicators, though, I would actually say it's a better buy than a sale. And from a fundamental perspective, it is cheap. So that speaks a little bit to the backstop that one has. So there you go. I'm not sure I can give you much more help than that, but there you go. SLV, we'll take a look at that. Oh, oh, I see. You meant SLV. You had Salt Lake City in there first, and you're from Laguna Niguel. Nice. Okay. Let's take a look at SLV. Let's just put SLV into the same. Since we're doing it this way, why not? It's more of a technical trade anyway. You could do this with the futures as well, but I'm just going to use SLV. That is not as positive. I think it's safe to say. You have to draw a line through buy and hold, right? Because that's not a strategy at all. That's just... So, excluding buy and hold as a strategy, this is what the technical indicators have for us. Wow, that's also very one-sided. That is remarkable. Not a single technical indicator has this thing as a buy, really. That's... Huh. I don't remember the last time I've seen that. Interesting. Interesting. FinWest, thanks for shopping at Lulu. Anything will benefit. Amex is doing their part to help. You know what? And FinWest, I have to tell you that I actually, and I said this, I believe, at the beginning of the year, and probably I did on one of these open mic live streams. I went over some of the benefits that American Express was putting into some of their cards. And I actually thought this was going to be a bigger boost to Lulu. That was my take. I thought it was going to be a bigger boost, but apparently not so much. Richie Rich 9452. Mike, I'm intermediate trader. What system? Okay. What system? I see a lot of Amber currently using Fidelity Trader Plus. Oh, are you asking me what system I am using? I assume that's what you mean. So, if you're not familiar with the system you're looking at on the screen right now, this is something called a Bloomberg terminal. It is very common for institutional market participants. Almost, I would go so far as to say it's de rigueur. So this is a Bloomberg terminal. Bloomberg terminals are used by a lot of people on the buy side and the sell side in the business. Everybody at our firm has one. All the traders do anyway. So if you're on the investment side, traders, PMs, analysts, strategists like myself, we all use it. I've used a Bloomberg terminal for at least in this form for at least the last 20 years. And I have a lot of muscle memory. I will tell people this. You don't need to get a Bloomberg terminal. A lot of the information that's available in a Bloomberg terminal is available in other applications too. But for those of us that use them professionally anyway, you just end up using the thing every single day. And so when you want to look at something, it just sort of becomes old hands, second nature to do it. They are very powerful. They have APIs. So I can pull information directly into my Excel sheets. And in fact, I do. So that Excel sheet I was showing you guys earlier, if you look in, you'll see various formulae. But let's see. So you'll see a whole bunch of stuff in here. So if you look up here, see where it says BQL? So BQL, and you'll also see a little Bloomberg tab up here on my Excel sheet, and there's add-ins for most of Excel. BQL is what's called Bloomberg Query Language. So all of the data that's in the system, including things like the current price and volatilities and Greeks or whatever it is I happen to be looking at. And in this particular case, so if you're saying, okay, well, what is Mike doing here with this query? So in fact, what is this whole sheet doing? What I'm doing is I pre-screen lists of stocks that I'm interested in. And I have said this many times before. I don't make it a secret how I think about things in the world. I like to look for stocks that have decent growth rates. They have to be growing at least as fast as the economy, preferably faster than the S&P, or trading much cheaper than the S&P. Better than S&P earnings growth, solid free cash flow yields, reasonable price earnings to growth ratios are things that I tend to look for. So all of these things. And then I also look to see, is it above a long-term average? As you know, I look at the 150 and the 200 most of the time. I also look for things like recent credit downgrades, reductions or increases in earnings or revenue estimates, looking at 1-2 quarters like that. So all of those are factors that go into my analysis. That's incorrect. All of those are factors that go into my screens, after which I will then do some analysis. What this is doing right here is I'm using the data in Bloomberg. I'm saying, okay, what was the lowest price that this equity has traded at, in this case, in the last 48 days? And the other thing you're going to notice is that, and then I have these numbers at the top, 15 and 45. What I'm doing is, if I'm looking at options trades going out in the future, I try to look backwards as well, just because I know what the volatility of the stock is. I also want to know what the price levels have been, So it has a high volatility, but am I at the low end of some range? Are we in the middle someplace? If I sold a strangle, am I selling a call above any price where the stock has been over the course of the last, several weeks? Am I selling a put below where it's been in several weeks? How far away am I? These are all things I like to look at, and I can pull that directly from the Bloomberg terminal. So that's the good news. Now let me prepare you for the bad. Bloomberg terminals aren't cheap. And mine is pretty stripped down at the moment because I used to have a lot of real-time international data feeding into it, like futures that trade in other markets, because we would trade ORDs. So stripped down to, just sort of a minimal amount of data. So if you look over here, you're going to see a little bit of a D. You're going to see a D here. So in this particular one, I'm not even getting real-time data into this. If you get a terminal, you're probably, and I should know this. And actually, I do kind of know it because I know what that last bill was. Yeah, it's over 30. It's over 30,000 a year. I was gonna say it's $3,000 a month. I've often said it was $3,000 a month. At one point, my terminal was 4,500 when I had almost every single bit of permissioning fired up on the thing. But it's not cheap, right? So if you are not a professional, there's probably other ways to get the data. They won't be as handy. Or maybe they will. I mean, because actually, a lot of the stuff is getting democratized. So there probably are some very good sources of data. But the sources of data that I have used historically on the professional side and that most people I know use or have used are the Bloomberg terminal, CapIQ, FactSet, and then there are separate trading systems that are really common. Fidessa, Charles River, Flex Trade. Those are all trading systems, order management systems. And then, in most cases, and they're different modeling things, but, at one of the trading firms I work for, we built our own trading systems. So they were, for options trading, it was completely built for our own use. But I think that the self-directed brokerage platforms these days, really, really good, and they're getting better all the time. You can thank people like Tom Sosnoff for that. Tom Sosnoff was a former floor guy. He traded himself, so he wanted to build a platform that he would use. He built Thinkorswim. TD acquired it. TD Ameritrade's platform is very good as a result. When he left that firm after selling it, he built another, Tasty Trade. Same thing. Justin Matthews says, I'd get one of those terminals, but Strategy has all my money. Yeah, I get it, man. So I think, I was at the Hood Summit, and it's a different kind of a thing. Obviously, it's a much more retail-focused platform. But they do a lot of, many times they do things that are really slick. And so, Interactive Brokers, a platform that I use, they have a lot of very good tools. Like I said, the aforementioned Tasty and Thinkorswim, now TD Ameritrade and Schwab platforms are good. Fidelity, I'm sure, has a good platform. So I don't think you need to have a Bloomberg terminal to do this. All of these things are probably available elsewhere. All of these technical indicators on my screen right now, you can probably get those right off of stock charts or something like that. What is the other one that's really popular amongst retail now? TradingView. TradingView is another application, and I think there's a free variation, and I think there's also a relatively low cost variation, which is good. And by the way, there are things that I don't use this for. When it comes to building an options strategy really quickly, I will tend to use options play instead, because it's just easier to build the strategy really quickly, to skim around. And I actually just went into the wrong, I think I'm supposed to go to a different URL, but so it normally would boot up a little faster than this. But, we were looking at package, for example. When I'm trying to just look up a trade and create it really quickly, I would almost certainly use this first. So I'd say, okay, well, I'm going to buy the stock, and I'm going to sell a call, and I'm just going to July 230. Look at that. It went to July 230s. I'm going to sell this 2 doubles like that. So I'll go 250s. Here we are. And there's my trade. Okay? So gets a decent score. I can see how much premium I'm collecting. I can see what my probability of profit is, see how much time there is to expiration, and if I want to modify it and say, well, is this one better? According to options play, at least, it's not. And that's based on a combination of how much you're making and the probability that the option goes in the money or not, and the 260s. So these two rank about the same. And actually, the 260s, that's probably because the market closed. I'm going to guess that that's that seems ambitious. Nevertheless, there are a lot of good applications. So don't worry about getting FinWest. Unusual Whales has so many tools. I haven't figured them all out yet. That's one of the things, right? So different, different tools for different tasks. If you're trying to structure something really quickly, this is a great app. And, you can get a lot of technical indicators in here as well. And this is, you can choose different studies if you want. I mean, and you can see how many there are. I mean, I just was talking about all of those technical indicators in the Bloomberg. There's more of them in here. And you can choose it even faster. When you guys see me whipping around on the Bloomberg, it's not because that's the best tool for the job. Oftentimes it isn't. It's just because I use this for virtually everything professionally. And so I just, know my way around. But yeah, you don't need to spend $3,000 a month. Certainly not. James Forbin, I have TradingView with real-time data, the best way to trade zero DTEs. So yeah, there you go. So I think there's a lot of good solutions out there. I'm just trying to show you data to look at. I'm not trying to show you a system to go look at it. Right? There are a lot of systems you can get the same amount of data. I don't know. I will, in fairness to the guys at Options Play, I don't know applications that are easier for that kind of work. If somebody calls me up and I'm on the, I'm in New York. My brother lives in Darien, Connecticut. If I'm going from Manhattan to Darien, Connecticut, and somebody calls me and says, hey, do you have a thought about something? This is the application I go to. I go to Options Play because it's the one that I could do on something this size, right? I can get the basic information that I need without going through a whole lot of stuff. So, again, tool for the job. That's the way to think about this. So I have chewed up at this point almost an hour and 15 minutes of all of your time. And for those of you who stuck around for it, I appreciate your time and attention, and I appreciate your questions and comments and listening to me complain about recycling here in Northern California. But it did inspire me to look at Package Corp. And I think that's kind of an interesting name. And I think that people should be diversified. I don't think you need to be only in semis. Let's leave it at that. But hopefully semis trades hold up until I see you next time, which will be Monday, 4:15 Eastern. Thanks for watching.